So, hello, and a massive hello to everybody. Hope everybody's having a great day wherever you are, whatever you may be doing. This is 50 Pips, rocking and rolling, 22nd of August, 2019. No trade calls, no recommendations, or responsible for their own stuff. We're here for educational purposes only. So, what's happening today? I mean, it should be an interesting day. Finally, we got this Jackson Hole starting, so heads up. Tomorrow's going to be the big Powell speech. But today's going to be interesting because we have all those PMIs coming out of Europe, and I think that's going to potentially set up some very interesting trades. And today, especially in the video outlook, in the video update that's going to be sent out shortly, we'll discuss about an opportunity in gold and euro into these PMIs on something which may seem counterintuitive. So we'll detail that as much as we can. Now, in the markets, following on to what we've been discussing here in these morning calls, is essentially right what has happened, right? So we had that December bottom, with Mnuchin calling the banks essentially the famous or infamous PPT back on deck. They catch market at lows and we start the ramp, right? So a lot of central bank talk to bid everything up. We had everybody on deck talking about how, everybody's got your back, buy. And we saw the ramp as equities recovered, right? Following that, what we had is we had a little bit of that, as we said, the technical term, right? We had a little bit of a shit show from Powell in July, but soon after that, we had Trump with his tweet storm, back with tariffs, and he keeps on talking about how useless the Fed is, how great the economy is, how great everything could be if the Fed could just keep on cutting and do QE again. And he's complaining about Germany and their recent auction, even though technically it was a failed auction. But again, there's still, as we've been discussing, right, as the yield curve is inverting, there's a lot of pressure on these central banks to do more, right? So even last week when the market was down, ridiculous, just slightly down off all-time highs, Trump called JP Morgan, Citi, Bank of America, and there you go, the PPT back on deck, everything is stabilized. So as we've been discussing, your base case scenario needs to be that it's whatever it takes to save the market, whatever it takes to keep the dollar down, whatever it takes for Trump to get reelected in 2020, but especially probably whatever it takes from avoiding the house of cards falling down, also because as pension fund crisis, etc., they want to keep stocks up. So that has to be your base case assumption. And odds remain that we got 98 probability of a cut in September from the Fed. The market was pricing an 80% probability in October, actually went down to about in the 60s after yesterday, and there was a pretty much 50-50 chance for another cut in December. So as we go into Jackson Hole, the only thing that should be on your mind is, one, base case is they're going to do whatever it takes, right? But what does that mean? That means that they have to deliver on some crazy assumptions, right? Or crazy expectations or lofty expectations or whatever you want to call it, that the market has put on the central banks and on the governments, right? For more stimulus, for more cuts, etc., etc. So even if that's the base case, and if we do get that, right, what you would expect is you would expect stocks to continue higher, to continue powering higher after that little bit of a correction, and we may see some liquidity events, and we may see some kind of short-term 5% blips, maybe 10% blips on a little bit of a tariff headline panic. But as long as everybody's talking about stimulus, everybody's talking about more QE, everybody's talking about more cuts, this should be supported to risk on flows. However, what you have to keep in mind, as we've been discussing, is it's always a little bit dangerous, and you always have to be cautious when everything seems to be priced for perfection. Because if they can't deliver for perfection, or if we slightly deviate from that expected perfection, or they can't deliver, or something changes, God forbid, inflation ticks up, or God knows what, there are a lot of things that need to be repriced. They'll need to be repriced very quickly, and especially in the current liquidity environment, well, then that could lead to shocks or some very aggressive moves or flashy, crashy kind of environments. Ultimately, we still think that those would be gifts from the gods in terms of opportunities to buy aggressively, but we're not there now. So again, let's see what happens. It's all about Jackson Hole. Things will be clear after Jackson Hole. Just keep in mind that what the base case is, what the expectations are, and that the market is putting on very, very lofty expectations for these central banks to deliver. So there's always a possibility that we get that the markets are disappointed and they have to readjust. And clearly, shorter term, especially if something changes on the inflation side, etc., the markets that are most overstretched right here are the bonds and to a certain extent gold. Guys, wishing everybody an awesome day ahead. Again, if you like these, just like them. Just give me a like on YouTube so I know it's worth me taking the time to put these out every morning. Have an awesome one. Take care. Bye bye.